Welcome everybody to Economica or Economica, and today I'm going to make a brief video about pound dollar, also pound yen and pound Swiss franc, to show you some interesting volatility analysis that I've done on the pound currency market, and why I believe that the pound going forward, I don't know when, could be going for another large depreciation. And in fact, as we can see from the pound dollar chart, here we have the 2007-2009 depreciation, 35% move down. Then we have here the big move down started in 2014, and then that has then consolidated with the 2016 Brexit referendum. Here we have this big curve down for the 2022 fiscal events, and from there the exchange rate has moved step by step, going up and down, up and down. This is a typical stochastic move, stochastic volatility. But what we have to consider, only from the price action level, we see that the currency goes to an exchange rate level and then has a big reprice down. It consolidates in a range for quite some time. It's a very long number of years, for example, and then you have a big move down. It has from 2016 we have consolidation in a range where the ceiling was 1.40, for example, with the top 1.42, and then it goes down to parity, 1.03. For example, in 2007 the top was 2.10 exchange rate, and then it goes down almost 36% to 1.35. So it's a very big move of depreciation of the exchange rate. So in the price action already we see these patterns that repeats every some years, where the pound is forced to depreciate against the dollar. This tells us that there are other macroeconomic variables that we are not considering now. I want to point out just one. The size of the US GDP, the United States GDP, is in the past year, 2023, was about $27.3 trillion. 27,300 billion or 27.3 trillion dollars, while the size of the UK economy is roughly 3.3 trillion dollars, which means that the US economy is 8.7 times bigger and larger than the UK economy. This without considering the reserve currency, which is the US dollar, and the size of the US capital markets. All the financial assets is all well above the $100 trillion, the US capital markets. So there is all the scope and size for the dollar to be a stronger currency compared to the pound, basically for the size of the economy, the size of financial markets, the importance of the currency, because between 60 and 70% of all global transactions, they are in dollars. Commodities are denominated in dollars. Most emerging market debt is denominated in dollars. Whatever you want to add as ingredient to this mix, you see that the importance of the dollar is larger than the pound. And so if we consider the price action along the time, this is measured in years because we are here back in 2007, and then fast forward in 2024 we have gone from 2.10 to today is 1.27 and change. So there is almost one pound in depreciation. $1, I'm sorry. The pound is always the same. So if before the financial crisis, if before 2007, the average American Joe had to pay $2 to have £1, today the average American tourist has to pay $1.27 or $1.28 to have £1. So there has been a big repricing of the exchange rate that what time goes, then it reflects the macroeconomic differences between the two countries, the GDP, and so forth and so on. So, apart from this brief introduction, what I'm gonna show you today is the volatility study that I've done with the cable pound dollar, and then I've chosen also pound yen and pound Swiss franc, because the yen and the Swiss franc, they are considered safe havens, like flat to quality currency, especially the Swiss franc, which is supposed to be more stable currency, also because of the SMB that pegs the currency at certain levels. For the pound and dollar, the pound and yen, the pound and the Swiss franc. For example, I want to point out that here for pound dollar we have this very high spike in volatility for the pound dollar, the most recent one for 2022, and this is idiosyncratic just only of this the dollar exchange rate, because 2022 pound depreciation to almost parity was due specifically to dollar liabilities in financial institutions, not really institutions, but hedge funds or investment funds, pension funds, insurance funds. So while the financial system that had exposure in dollar liabilities or pound has seen a lot of pressure from the exchange rate volatility, compared to, for example, to pound yen, which is very the line is much lower, and pound Swiss franc. Also, for example, if we pick and choose the pound Swiss franc, we see this is very high bar here, which is before Brexit, and that is the time series that is telling you that, for example, the Swiss central bank from one day to another decided to unpeg the currency, the exchange rate, and then all of a sudden the whole hell breaks loose in the FX market. And so you have this very high spike of volatility in a very short period of time, because we see from the graphs we can learn that volatility, it's stable, it stays in a range for quite some time, then it gives you some 1 day or 2 day moves when it basically the market starts to show some widening of price action, and then this fits through the market behavior, the positioning, the momentum, the market sentiment, and then basically you have the rise, the increase in volatility. That is the effective market event of price dislocation and asset prices going down or maybe going up so much. But so once the rolling standard deviation has been calculated, it's been basically goes into matrices, so it's a very nice funky graphs. It's very easy to understand. So we see that also from the data here the 7-day rolling standard deviation, the coefficient is 0.68, so it's a moderate to strong coefficient. 68% of a move in pound yen is explained by volatility that has happened, or it's in pound dollar. And for example, what happens in pound dollar explains 48.2% of what happens in pound Swiss franc. This is for the 7-day standard deviation. The 21 days rolling volatility average, it gives you a higher correlation coefficient, 0.75 between pound dollar and pound yen, and 0.55. So, as I said, very important feature of volatility is that in the longer period, if the volatility is persistent, then the correlation coefficient, it tends to be higher. And this is a very important thing, because it can be utilized to forecast volatility in future, so that you can basically hedge your position, or try to set up a strategy to profit from dislocation in the market. If you can forecast in the 1 month, 3 months, 6 months, there can be some volatility in a determinate asset class, or a financial asset, or a currency, you can position and try to profit, or have a strategy to see what works in the market. Okay, so these are the distribution of the 7 days and 21 days standard deviations, which are not very nice. So going forward, I've started to okay, these are this is more explanatory, because in these graphs there has been added the realized volatility. So the realized volatility is the threshold that serves you to understand, okay, the short-term volatility or the 20 days volatility is going to the threshold of the average realized volatility. So it means that there can be a sudden increase or a spike in or a market event, a price move, larger price move, which I can profit, or I have to hedge to. Very simple example: if I am I don't know, if I am a US if I am an exporter, and I expect in 3 months' time to receive, if I'm in the UK, I have a business and I export some products to the United States, and in 3 months' time I expect to receive dollar cash flow, then in that case I would like to know if the exchange rate is the same, or if any fluctuation in the exchange rate can basically change the cash flow figure, the net cash flow figure for any exporter. So these exchange rate changes, they are important for large businesses and those that have cross-border trade in different currencies, and this is hedged by institutional like banks, or mostly by banks, with options, or mostly with forward, so which is another kind of derivative that I'm not checking today. But anyway, the realized volatility, basically it's a threshold that when it's crossed, it tells you, okay, maybe there's going to be a change in the level of the pound or the yen or the dollar or the Swiss franc. And this can be utilized for speculation, or if you are an importer or an exporter, you want to hedge your currency exposure of your cash flows, which is sometimes, I mean most of the time, is an important thing to do. Okay, so going forward, I started to apply some econometrics volatility study, and I started with a simple ARIMA, which is ARIMA 101, which is not very satisfactory because this ACF graph, I don't like it at all. There is a very strong autocorrelation, and so I decided to improve, to change the econometric model, and I went straight for a GARCH. But before checking the GARCH, because I saw that there was this big lags in autocorrelation, I decided to check for the residual error. So I said, okay, I want to know if the variance error has some sort of autocorrelation, and if the time series is stationary, or there are some other factors that doesn't allow the ARIMA model, for example, to be a good fit for to understand the volatility in time series. So basically, after having analyzed the residuals in the graphs, I can see that there isn't much autocorrelation in the residual errors, which is not the time series. So the variance, the error of the variance, we want to see if there are lags of autocorrelation, but the ACF here chart says that the autocorrelation is 0. Also here we see that residuals, they are clustered in plus or minus 0.05. So this would tell me that the residuals or the time series should be mostly stationary. But I observed that this graph gives me some extreme values, some outliers, and this basically tells you, okay, the time series is stationary. There is no autocorrelation in the residuals errors, but the values in the QQ plot have some outliers. So there is some exogenous factors or some high volatility periods that deviate from what is the normal distribution of the returns. So after having checked the stationarity for the residuals, for pound yen and pound Swiss franc, for example, what I was saying before, we can see it here. This is the pound yen QQ plot, and mostly the residuals, they are in line with what the red line tells you what should be the normal distribution, the normal pattern, and but there are these dots here which are extreme values or outliers. And also if we read this, I'll try to make it larger so that, yeah, okay, let me make it smaller one, sorry. Okay, so we see that the mean it's 0.004. That means that the mean of the residual error is very close to 0. So the time series is stationary. And also if we go about and we change by 25, 50 or 75%, we want to account for the deviations, we have values that are very close to 0, 0.03 or 0.5 or 0.65. So most of the blue line is similar to what should be the normal distribution, but if we see minimum value or max value, which is this minimum dot minus 15 and maximum value 25 plus 25.7, we see that there are some few data or parameters which are outside what is the normal distribution, and this tells us that in the this okay, yes, the time series is stationary, but be aware that there are some volatility events that are fat tail risk in the time series that you have to bear in mind and be aware of. Okay, so going forward, to be sure that the volatility study was made properly, I had to check for a Garch model, which we're gonna take now. So luckily we got very fast on the Garch model. And so we basically the Garch model gave me some good results, but still, as you can see here, the covariance estimator is robust, okay, but the optimizer does not indicate successful convergence. So there are some parameters or results that are misaligned. So what that means in simple terms is that the Garch model, the 1-1, it gives you a very nice graph and chart for the volatility, but it doesn't fit fully the whole time series, or it doesn't give you the full explanation of the time series that I've taken here from starting from 2004 to 2024. There are some volatility patterns that are not captured in the Garch 1-1 model, and so further modeling or other kind of studies have to be made to find what is more suitable. So, but standing on this very quickly, so we see that there are two the chart comes up with two parameters, which is alpha and beta. So alpha is the sensitivity of the time series volatility to exogenous fact, so to news. So can be market announcements, it can be a fiscal announcement, something that changes in the dollar, which is not related strictly to the effect to the currency market, but is an external fact, which I was saying it can be fiscal policy or anything else. So the alpha coefficient tells you, okay, 5% of volatility is derived from the sensitivity of exogenous factors on the time series behavior. While when you have volatility that materializes in large price changes, in this case for the exchange rate, the beta terms tells you, okay, the parameter here is 0.929 periodical, 99999, which could be 0.93, whatever. It tells you that it's a parameter is close to 1, and this explain that the volatility is here persistent. So that when you have a spike in volatility, that pattern of volatility is persistent. It fits through the data also in the following periods, and then it repeats. And this is visible, for example, the 2007 2009 financial crisis. So pound dollar was very, very fine, no problems here, very contained volatility in a range, normal market volatility. And then there is, all of a sudden, there is a big move higher, and then it stays there for a while, and then slowly goes down towards another range. Okay, but it takes its time from 2008 or 9 down to 2010 or 12. So it takes a what, 12 to 24 months for the item volatility to decrease and go into a range which is normal. Okay, so there is persistency, and this persistency that it stays in the data, then it flares up again, because then you have 2016 big jump in volatility, and then the pattern repeats, because goes down, it clusters in a range, and then goes up, and then goes down. So the chart, it's clear. It's definitely, it's not this one, probably it's this one upside down, but it helps measure and it also is very useful to forecast going forward what can be an increase in volatility, so that any hedge fund can be aware that, for example, in a following period, in a certain period of time, probably, I don't know, that exchange rate or that financial asset can experience a larger moves in changes in price, market price. Okay, so we see here that after 2022 volatility has gone down and it's clustering in a range, but it's bottoming. It's in a range, but it's there probably to go up again for some other market move. That, for example, it can be another depreciation of the pound for some other reasons, which can be fiscal constraints, or it can be, for example, a change in US dollar stance from the United States, and we can see the pound going down, and also the euro going down, or the Australian dollar going down, like G10 currencies. Or it can be the opposite, because we cannot know the future. It can be that volatility is higher, but actually the dollar goes down and the pound goes up. It's not a given. I mean, we don't have a crystal ball and we can know things, but that's why GARCH models are made to understand and study the deviation of, or the volatility of financial assets. And again, the residual from the GARCH model, they are all clustering, and you see these big lines that deviate outside the normal range. They correspond to the higher line in the volatility events, which are in a short period of time. Okay, and also the QQ plot is mostly symmetrical, but there are outliers, especially on the downside. We have a minus 0.08, which is a big outlier. Okay, same GARCH 1 for the pound yen, which is robust, but we didn't have the error of the convergence error. Okay, so GARCH model, to simplify the thing, because there is we can consider, for example, this mu coefficient. Okay, this mu coefficient is the average mean return, and for example, for pound yen, it's positive. It's a positive parameter. the mu, the average mean return coefficient for pound dollar, is a negative parameter. This is e to the minus, so it's 0.0000 minus 00, very small number, but between plus and minus there is a difference. This is a positive coefficient, 0.000192. This tells us that because the mu coefficient is positive, for example, from a trading standpoint, pound yen, it's suitable, it can be utilized for carry trades, because mean returns, they are positive, so carry trade can be set up or can be used for pound yen. Okay, this is a difference that that comes up when you check some other in-depth parameters, and we see here minus the mu coefficient, we see 1.9, so we have a mean return which is positive. Okay, pound yen can be used for carry trades. I wanna be long, mostly long pound yen, and then I can hedge the volatility of currency pair. But again, the alpha parameter 0.10, so 10% of the volatility, the fluctuation of the Gauge model for pound yen is explained by exogenous factors, news sensitivity, the persistency coefficient of volatility, the beta coefficient, is 0.88, so it's still very high value of persistency of volatility. The residuals, they are usual, normal clustering, and outside volatility, which corresponds to the 2008 or 2016 volatility events, and we have outliers here in the residuals. The same is for the pound Swiss franc, which has a very high beta coefficient, but pound Swiss franc has Swiss chocolate, it has a very low volatility. It's very low volatility this is by of the nature of not the nature, but how the SMB keeps stable the Swiss franc. So there is low volatility, but there are some very large outliers because of market correction, or as I said, in 2014, 2015, we had the SMB that changed monetary policy and say, okay, the currency is not pegged anymore, and so whole hell breaks loose, and volatility goes higher and higher. So let's see what we have here. Yeah, we have the ACF residuals. We say that they are very close to zero, so there is no autocorrelation for the residuals or the error of variance. Let's go forward. As you can see, I'm not reading from the script. I haven't prepared anything apart from all this study that I've done, and I'm just going down here, not going down, but double checking the whole thing that I've performed with this pound, dollar, yen, or Swiss franc exchange rate, and after the Gauge model, I checked what were the VAR levels, which is the value at risk level. You see here these fancy percentages, VAR 95, 97.5, 99, etc. So these are, as the realized volatility, these are the threshold that tells you, for example, when there is that one day very high market move, very large market move, it can violate one of these four parameters. VAR 95, 97.5, etc., etc. VAR 95, very simple. What is that one day that volatility market event, which has a 5% probability, that there is one day move that is larger than a certain parameter, okay, which is larger, for example, than 1% here, or larger than 2%, or larger than 3%. What is the probability? The 0.1 probability, the 1% probability, etc., etc. So these are the distributions. But as I was saying before, I said I've showed you that the Garch model for the pound dollar, it had that going briefly back up again. Here, the covariance estimator is robust, but the optimizer is not. It isn't successfully convergent. Okay, so to do that, I had to change the Garch model, and I discovered that a good fit model is an E-Garch model and the GJR Garch model. But what works most with currencies time series is the E-Garch model. It's what, from the results I have, it's what fits most the time series and explains most the volatility patterns across time. So meanwhile, I was thinking about the Garch model. I say, okay, let me double check what are these VAR levels for these currencies. Now, VAR is the very famous 4 p.m. report. So the 4 p.m. report is something that any investment bank has to do every day at 4 p.m. and it has to report to the CEO or the CFO what are the VAR levels of the the portfolios that the investment bank is holding. Okay, and the VAR levels we will see very quickly here. They are these numbers, and it's like that. Is very simple. So what is the 5% probability that I have one day a 0.0943 price move in that financial asset? In this case, it's only for pound dollar. So this is a 1% minus. It's the minus 0.95% move down, depreciation of the pound. So what is the 5% probability that one day the pound goes down minus 0.95%? And that is the VAR parameter. Then I apply the VAR parameter and say, okay, check for all the time series that I've got here, 20 years time series, how many times these VAR parameters or threshold have been violated. So there has been here, plain English, exceedance of VAR. You want to know if it's goal, if it's no goal, if it's offside, if it's whatever it's happening, you call the VAR and go and double check. And so in 20 years, 272 days, there have been VAR violation for the 95 VAR. It's very simple to read. 97.5% VAR, 136 violations, 136 days, trading days, and VAR 97.5, it's 1.18% to the downside. VAR 99, it's 1.58%. VAR 99.9, it's minus 2.99%. Let's make it minus 3%. Okay, so this is very funny because in 20 years, 2004 or 424, only 6 times, 6 days, pound dollar has exceeded a minus 3% move. And these are the red dots. The red dots is 3 dots in GFC, the Great Financial Crisis, which has the most, and then 3 plus 3, 3 plus 1, Brexit, plus 1, COVID, plus 1, 2022. So you can see the moments in time where there have been the largest price move or percentage change deviation from the mean average, the rolling 30-day mean and the average 30-day standard deviation. And this has been basically worked with the VAR parameters, so that on the chart there are these dots that point you out when these days of high volatility and VAR violation have occurred, but in a very long time, which is 20 years. I would say it's normal, but still, for example, the 99.9, so the 0.1% probability is a very large move. It's minus 3%. It's a very large move. I mean, Brexit, we gone almost minus 8% down. The GFC has gone almost 3.5-4% down. COVID 4% down. 2022 fiscal events 4% down. So the currency is, but there is, for example, you see here around 2022 there is a clustering of dots. So the also if we observe the yellow line, you see that the standard deviation line goes up. So it means that the volatility is going up, and the VAR basically reflects the price moving. Reflects the chart. So you see the VAR goes down. You have this dot, nice red dot here down, is the movement of actually the exchange rate, while the volatility goes up and moves on the opposite side, but it doesn't go up not because everything is fine, but because markets, they are moving with very large moves, and so volatility is higher, and then so the prices gap down a lot. And so we see the dots here, and 07, 09, the big price down minus 35 or 36%. But what I was saying is that there is a concentration or a clustering of dots in a small period of time compared to other period of times like here. There are very few days of high volatility, while when there are market events, there is a concentration of dots. And this because goes back to the concept of the beta parameter. So that the beta, or that the volatility in a financial asset or a currency is persistent. It feeds through the data, and then it spikes. It increases suddenly in a very short period of time. But in markets, when you start to see volatility recurring once with more frequency, okay, that means that there is a build-up of volatility, and then you can expect volatility to go even higher. So in that case, you have to be edged for a large price move in the financial asset that you are exposed to, or you want to have a speculative strategy and you want to profit from a pound depreciation, a very large move, minus 4%, minus 8%. I want to be short the pound because this is going on. Okay, and volatility helps you to foresee to capture this pinpoint data and to be more aware of what is going underneath the market, which is not is not visible in the price action move. You see the green candle, the red candle, but you don't know how large is the volatility. So the candle is the same color, green or red, but you don't know what is the amount of volatility. So if you know the volatility beforehand, you can expect, or you can foresee larger moves, and then this helps you to trade or to hedge your cash flow exposures, many useful things. So we have the same for pound yen, and the same for pound Swiss franc. And the VAR 99.9, funny enough, it has been only six times for all the time series. And yeah, more or less the violation, they are the days counted, they are basically the same, if not similar, exactly the same, but the percentage change is different. For example, the VAR 99.9 is minus 3.4, while the VAR 99 for the dollar is 2.99, or only 3%. So there are these little discrepancies between the currency pairs, but the data more or less is the same, is consistent. And as I said, I tried to do a forecast of an ARIMA. The ARIMA has been very funny because it gives me a pound going up, so nothing is lost. ARIMA is forecasting something that it's contrary to my beliefs, so that the pound will go down to parity with the dollar in a long time. So let's go very fast to the eGarch models. And the eGarch models still gave me the convergence error. I didn't pay attention to this before. But no, probably, yeah, that was the Garch model gave me the error because it was not scaled. So I had to scale the Garch model by 100 to make it fit properly. And finally I had the covariance estimator is robust and no problems at all with this. And it came up with slightly different parameters. I mean, the mu coefficient, the mean average returns is negative for pound dollar, so we have slight negative returns on average. And the alpha parameter, instead of being 0.05, it's 0.10. So the eGarch model tells me that the exogenous factors, the sensitivity of news on related to pound dollar, it's higher, and the beta coefficient also is higher. It's 0.98 instead of being 0.92 or 93. So it tells me that overall the volatility for pound dollar, the persistence and the exogenous factors are higher. They have a higher effect on the price movements of the exchange rate. And yes, the eGarch model is the econometric model that I would use for currency pairs. The mu coefficient for the pound yen, it's positive mean. So again, pound yen is good for carry trades, and the alpha coefficient is 0.16, it's higher, and the beta coefficient also it's higher, 0.98. This is pound Swiss franc. We have a slightly negative average mu coefficient, average return. The alpha coefficient also is higher, 0.13. The beta coefficient 0.98, all very high beta coefficient. So the persistency of volatility for the EGARCH model, it's very consistent. The GJR, this one, GJR, it doesn't work very well. And you see we have completely different results. The alpha is very low, it's much lower. The beta it varies, but almost the same. So I opted for the EGARCH model to do what? Basically, I have utilized the EGARCH model to work out, to understand what not to understand, I mean, sorry, to compare the past volatility of the time series with the future volatility. And I've done this by taking the Greeks of the option chain for the pound dollar of June 2025. So I came up with this this normal standard thing that can be done with the econometrics. So basically taking some parameters that are in the future and then comparing it with what is already built in the time series volatility, so to see what are the discrepancies, the differences, and most often the implied volatility of options. It gives you some it tells you that markets are pricing some levels of volatility that which are not expressed or captured in the time series volatility, because the time series volatility, it tells you what has been the volatility for all the past data. Option chains, derivatives markets, it helps you to see how the market is pricing future asset prices move. What is the price of or the exchange rate level 1 month, next week, 1 month, 2 months, 6 months from now. So you can compare these two market factors and try to come up with some hedging strategy, for example, or some speculative strategy. Or if you, for example, if you believe that the pound will go down against the dollar, then you can try to see what are the volatility patterns that can, for example, create an hedging strategy or a speculative strategy to short the pound. So here the EGARCH and GJR GARCH line have been overlapped. They are almost the same, and it gives you some other parameters, which are the mean squared error or the mean absolute errors. These are these are important parameters, but they are not relevant for the option strategy. So, as you can see here, the Greeks for the option table has been uploaded, the file, and then I started to code for to see graphically what are the distribution. Very simple histogram, not Instagram, histogram graph with the bars, and you see the frequency. So what is the density of the frequency of the parameters for the implied volatility. So you see most of the implied volatility for June 25 pound dollar option prices is mostly priced between 7 and 8%. Most of the value is a little bit more than 7% of implied volatility. These are the Z-scores, so how many standard deviation. So it's a -1 standard deviation for a 7 to 8% implied volatility. And then I like to see the distribution of the Greeks, so the delta, the gamma, the theta, and the vega. So the delta measures the sensitivity of the option premium to the price changes of the asset. So for how the exchange rate between pound and dollar is changing, the delta gives you the parameter for how much the option premium changes. So how much you can gain or lose with your option strategy, for example. So if you have a put on or a call, then the delta can be positive 0.25 or negative 0.25. This is a normal distribution. So the option premium gains, for example, 25 cents, and then you can gain from an option strategy on currency or stock options. Gamma T, I won't bother you with these other Greeks because I want to go to the core of the thing. And yes, so here I came up with very nice fancy graph of the 3D volatility surface of implied volatility. So this eye here, yellow point here, it's high volatility, 14% volatility, and it's basically in line with an exchange rate parity between pound and dollar. Most of the volatility, as we saw before, is between 7 and 8%. For this kind of exchange rate level would be 1.2, 1.3, a little bit more than 1.3. So this is a very nice fancy graph that anybody can find, for example, on platforms. I think Saxo Bank has this nice kind of feature. And then with the Heston model, I tried to measure the option sensitivity by stress testing the market, because I like it to see what happens if the pound goes down -10%, -20%, -25%, how changes the average implied volatility, how changes the delta, how changes the gamma. And then it gives me also the matrices for the Greeks correlation. And the implied volatility, the average implied volatility, it's lower because a -25% move in the option in the exchange rate price it's basically out of the money, or definitely something that is unforeseen, or it's not priced in market. So these are kind of stress test scenarios which are useful if you want to check it out, but they can be used in a real market environment. So this is the nice graph. This is the volatility smile, this blue line, And this is what I was saying before, comparing the volatility of the time series with implied volatility that it's forward-looking. In this case, it has been extrapolated from the June 2025 option chain, the Greeks of the option chain, and the orange line is the smoothed gauge, so the time series volatility, and the graph on the x-axis has the exchange rate levels. 1, which is parity, 1.1, 1.2, this is pound dollar, 1.3, 1.4. Now the market is between 1.2 and 1.3, non si può dire, closer to I'm sorry for you can hear my Italian, so I make mistake in English, my accent is very bad, so closer to 1.3, because the exchange rate today is 127.6 handle or something, so it's closer to 1.30, 1.3. So I was saying that the orange dashed line is the gauge, and as you can read here, the confidence interval of the gauge, so how large can be the variance of volatility, and the blue line is the implied volatility, so it's the line that reflects the implied volatility in the option chain. The red dots are the deviations from the implied volatility interpolated with the gauge volatility. So the red dots are useful to find out what are the exchange rate levels that deviate from the intersection between the implied volatility and the historical volatility. In fact, we see that the red dots are outside the orange lines. But this one, which is 1.2, pound dollar 1.20, and I want you all to reflect on this, that now the market is pricing 1.2760 handle. The color of the bar is green, so this is a monthly chart, so probably for the whole month of December the pound will go up, but these three dots are near 1.20. Okay, so if I want to apply a trading strategy based on this chart, which I'm not suggesting you to do by any means, I would say that the exchange rate will go from what is today 1.27 will go down to 1.20 around these three dots. Okay, so the pound will depreciate towards the dollar around a 20% premium. Okay, 20 cents difference. But this is the Bollinger Band. I was telling you, people who do day trading, they see the Bollinger Band and say, okay, the trend line is gone against the upper band in this case, and then I have a confirmation with the red candle, the trend, the price action has reversed, so we are going to the downtrend. Now it's sitting in the middle line, so it's a bit of price discovery. So the market wants to understand what it's doing, or the market's basically is trying to price the future, the forward path of the forward direction of the exchange rate. But here the lower point of the Bollinger Band, strangely enough, it's 1.2150, which correlates very closely here, these three dots. So there are some points that you can pick and choose to create your hedging strategy or speculative strategy. But normally, I mean, here we have green candle, red candle, goes down, then it stalls a little bit around the middle line, and then it goes down until it basically it goes, and here this is the 2022 almost parity 1.035, so it goes well below, well outside, because this is a Bollinger Band with 2 standard deviation. Probably if we put 3 standard deviation, we are able to capture the thing. No. Oh yeah. So this is a 3 standard deviation move. This big move down. More interesting, even more interesting, it's this 3 standard deviation move. It goes well below the 120. So we can play around this thing anyhow, in all sorts of ways. What I was trying to say is something very simple. So basically that normal price action movement goes to one side, trend reversal goes to the other side, trend reversal. So it's a ping pong movement, up and down. So I would expect after some sideways going here, then basically the pound will do this. Okay, we sort of left shoulder, head, right shoulder, boom, down. Okay, to go and test this market level 121.50, and then go up again in a yo-yo ping pong moving or market drifting of the exchange rate. And from this graph we have this data which is interesting. It's correlated with what I was saying, that the implied volatility, its parameter, it's 8.94, it's higher than the historical volatility of the e-Garch model. But this means that the market, it's in 6 months' time is pricing something that it can be found in the historical volatility, because it's forward looking the price movements of the exchange rate. And I went and checked out also for the skewness of the implied volatility. The skewness basically tells you, here we see that the skewness of the implied volatility, it's positive. This yellow line here, we see that it's skewed more to the positive side, from 0 to nearly 0.4. Okay. Now the exact values are here. It tells you that the mean, the average implied volatility, it's 0.03. The skew distribution, and the average plus the standard deviation of the implied volatility skew, it's 0.34, plus or minus. And yes, the skewness parameter is 0.65. So the skewness is positive. And yes, that's all for this episode of Oikonomika, which is a fancy Greek word for economics. And yes, today we seen something with related with Greeks, option Greeks. the delta, the gamma, the implied volatility, which is not a Greek term, and how implied volatility it's functional to forecast the future volatility and price movements in asset prices or exchange rate in this case, while volatility models as the ARIMA model or the Garch model or eGarch model, they basically extrapolate the volatility for the whole time series that you can choose. So it's basically a graphical representation of the historical volatility, and then you can analyze and see what are the volatility patterns when these big market movements have happened, and how you can apply these patterns